Is this a China economic recovery story? And where would you go, onshore or offshore, in order to take advantage of this opportunity?
So, yes, sure. I mean, if we look at the China story, obviously a very different stage of the economic cycle relative to the rest of the world, particularly obviously the US, where we're expecting a very high probability of a recession in the next 12 months, and recent data just reinforces that. So from a positioning perspective, we're overweight Asia ex-Japan assets generally, actually, bonds and equities, on that recovery story and the reduced credit risks and increased cash flows that we're expecting to come through from that. In terms of onshore versus offshore, we're pretty balanced. Maybe have a slight preference for onshore equities at the moment. Obviously, we are overweight the cyclicals, though. So from a sector perspective, consumer discretionary, communication services and industrials are all in the areas that we like at the moment for the Chinese, from a China sector perspective. So that's the way we'd be playing it.
Your neutral Indian equities, though, I've seen that call recently a lot, where people prefer China over India. What's your reasoning behind that?
Yeah, so it's a good question. I mean, we were overweight Indian equities through last year. So we reduced it towards the end of last year as we came into the beginning of this year. It was largely a valuation story. Relative valuations obviously still very much favour Chinese equities. Obviously, the growth story in India is probably is stronger and more sustainable, more importantly. So obviously, at some point, we'll be revisiting that. But at this moment in time, we do feel that the Indian market is probably a little bit less resilient to facing the headwinds internationally, again, amidst the reopening that we're seeing in the Chinese economy.
Yeah, there certainly is a compelling growth story for both China and India at the moment, but more broadly in this environment, how is your risk appetite?
Yeah, so I mean, we are generally down on risk. So we are underweight global equities, particularly obviously in the developed markets. So I guess if we rewind 3 months ago, we were saying there's a 75% probability of a US recession. We've upped that to 80% now. I guess the story then was that most of the indicators were pointing to a recession, but the labour market was still very strong. We've seen further evidence of it overnight, that labour market strength is starting to come to an end. So the more forward-looking indicators are suggesting that we're going to see higher unemployment going forward, and that obviously heralds a recession. So, earnings are being already revised down, but we think that's still got a long way to go, and so that US market and European equities we still think face significant headwinds and a potential significant leg lower before we see the Fed pivot and support and focus on supporting growth rather than fighting inflation.